Hi guys, Ben here and welcome to Motivation to Invest. Bill Ackman is one of the greatest and most controversial investors of all time. He is considered by many an active contrarian who takes bold bets against the consensus. As the founder and CEO of Pershing Square Capital, he is worth an estimated $1.5 billion. He is probably most famous for his public feud with the great billionaire investor Carl Icahn over Herbalife, the pyramid scheme. Ackman betted $1 billion that Herbalife stock would fall to zero, and then Carl Icahn took an opposing position. This caused the two to ensue in a public feud. In recent times, Bill Ackman has turned $27 million into $2.6 billion by predicting that the global health crisis will cause the stock market to crash. Moreover, Ackman recently sold his shares in Warren Buffett's Berkshire Hathaway so his own investing firm could be more nimble and take advantage of a potential stock market crash again. So it seems Bill Ackman has no issue making bold bets against the consensus. But what gives him this confidence? In this video, I'm going to reveal Bill Ackman's 20 rules for investing success. If you appreciate the hard work which has gone into compiling this video, go ahead, hit that like button for the YouTube algorithm. That allows us to produce more content like this for you guys. In addition, you may wish to subscribe to this channel for more investing tips and exclusive stock market picks, which I personally have invested in. It's good to be first on the scene when a great stock is at a great price. With that being said, let's dive in.
The investing business you can learn by reading. Read everything Warren Buffett's ever written, watch every YouTube video he's ever appeared in. That's a great way to learn about investing.
But give us just a take on why so few names and...
So for a bunch of reasons. I mean, I've always had the view that, why not own the best 10 or 11 investments as opposed to ideas 12 through 25 or 12 through 100, which is more typical. And, I think there are very few great investments at any one time. So the ability to concentrate is an enormously valuable asset of a strategy. The problem with it is it leads to bumpier returns. And it leads to more attention on mistakes or things that aren't going well. I don't know a portfolio manager that doesn't have a stock that's down in his portfolio, right? But you don't read articles about, we're getting an awful lot of attention for a pretty high profile situation that's struggling. But I think there's, it depends on what your business model is. But if you want to make high rates of return over a long period of time, it's hard to do that being very diversified. I mean, if you look through the Forbes 400, wealthiest people in the world, most of them made their fortune in one business or a portfolio of 2 businesses. Very few made it in a portfolio of 100. So it's that, and the other benefit, it allows you to run a much simpler investment firm. We have an 8-person investment team. If we had 30 names, we couldn't manage that portfolio the way we do with a small team. By having a small team, you can hire better talent.
There's actually an argument that some people are now making that, buying the index or buying diversified funds have had much better returns than buying, those hedge funds that have, a very specific smaller portfolio approach like yours.
I haven't seen that article. I mean, I think we've done very well relative to any index alternative, certainly. So it depends on how you judge us. I think if you judge us on a 90-day basis, I have no idea how we're going to do relative to an index. But I think this is a strategy that over time should earn a meaningful premium over any kind of benchmark, or you shouldn't give us your money.
Yeah.
To be a successful investor, you have to be able to avoid some natural human tendencies to follow the herd. When the stock market's going down every day, your natural tendency is to want to sell. When the stock market's actually going up every day, your natural tendency is to want to buy. So in bubbles, you probably should be a seller. In busts, you should probably be a buyer. And you have to have that kind of a discipline. You have to have a stomach to withstand the volatility of the stock market.
Yeah. So talk to us about the Bill Ackman strategy or that mental checklist that you go through.
So we look for very high quality businesses. What we describe as simple, predictable, free cash flow generative, dominant businesses, a business that Warren Buffett would describe as having a moat around it, right? If you believe that the value of anything financial is the present value of the cash you can take out of it over its life, well, you need to know how much cash it's going to generate over its life. So business quality to us is the single most important criterion for determining what's interesting. Because if we can't predict the cash flows We don't know what it's worth. If we don't know what it's worth, we can't invest. So we figure out what it's worth, figure out how good the business is, how predictable will this cash flows be from a railroad or a spirits company or a real estate company, a shopping mall business.
We bought the stock of a company called General Growth when it hit 34 cents, down from $34 a share. People just don't make money, or hadn't until that point in time made money buying the stock of a bankrupt company. It's been 110, 15 times profit multiple of the original investment.
Figure out what it's worth, figure out how good the business is, how predictable will this cash flows be from a railroad or a spirits company or a real estate company, a shopping mall business. And then we say, okay, well, where's it trading? And if there's a wide gap between price and value, you can buy it for 50 cents, it's worth $1.20. Well, then we're going to take a hard look and try to understand why it trades at a deep discount. And once we understand the reasons, we decide, well, these things that we can solve. You know, can we, in light of the situation, the circumstances, can we be influential in changing these levers that can cause this valuation discrepancy to narrow? And is this a business that, while we're causing the valuation discrepancy to narrow, we can also perhaps contribute to the valuation growing? And if those things are true, we found something that looks quite interesting for us.
How do you be a successful investor? Now, I'm assuming that you're not going to go into the business of investing. I'm assuming that you're going to be a doctor or a lawyer, you're going to pursue your passion, but you're going to have some money that you're going to save over time. And I'm going to give you my advice on the topic. It's not necessarily definitive advice, but it's what the advice I would give my sister, my grandmother, on what she should do if she were in the same position. I'd avoid investing in startup businesses where the prospects are not very well known. Because again, you don't need to make 100% a year to have a fortune. You just need to invest at an attractive return, 10, 15% over a long period of time, your money grows very significantly. So how do you avoid the riskiest investments? My advice would be to invest in public securities, invest in listed companies, companies that trade on the stock market. Why? Because those businesses tend to be more established. They have to meet certain hurdles before they go public. The stocks are liquid, so you can change your mind if you want to sell. If you invest in a private lemonade stand, it's hard to find someone to take you out of that investment unless that business becomes fabulously profitable. So that's piece of advice number one. Invest in public companies. Number two, you want to invest in businesses that you can understand. What I mean by that is there are lots of businesses that you deal with in the course of your day and your personal life, whether it's a retail store that you know because you like shopping there, or it's a product, your iPad, or that you know you think is a great product. But you have to understand how the company makes money. If the business is just too complicated, you don't understand how they make money, even if they've had a great track record, I would avoid it. And a lot of people thought Enron was an incredible business because it appeared to have a good track record, but very few people understood how they made money. It was good to avoid it. Another very important criteria is you want to invest at a reasonable price. It could be a fabulous business that's done very well over a long period of time, but if you pay too much for it, you're not going to earn a very good return. The last bit is that you want to invest in a business that you could theoretically own forever. If the stock market were to close for 10 years, you wouldn't be unhappy. What do I mean by that? Now, again, if you're going to compound your money at a 10 or 15% return over a 43-year period of time, you really want a business that you can own forever. You don't want to constantly have to be shifting from one business to the next. And what are businesses that you can own forever? Well, there are very few that sort of meet that standard. Maybe a good example is Coca-Cola, right? What's good about Coca-Cola is it's a relatively easy business to understand. You understand how Coke makes money, right? They sell a formula or syrup to bottlers and to retail establishments, and they make a profit every time they serve a Coca-Cola. People are going to drink a lot of Coca-Cola for a very long period of time. The world's population is growing. They sell in almost every country in the world. And each year people drink a little bit more Coca-Cola. So it's a pretty easy business to understand. And it's also a business that I think is unlikely to be competed away as a result of technology or some other new product, right? It's been around long enough. People have grown used to the taste. Parents give it to their children, and you can expect that it'll be around a long period of time.
So you're known for occasionally hiring people with some non-traditional financial backgrounds, a former fly fisherman, a tennis pro, someone you met in a taxi. So what actually are you looking for?
So most of the people that we have on the investment team are people with more conventional backgrounds. Half the team worked at Blackstone in either private equity or investment banking. A few guys from Goldman Sachs. But I'm a big believer, I had internships in my life, and if I meet a great human being, I want to give some, people who didn't go to Harvard Business School and didn't work at Goldman Sachs for 4 years, some exposure. So I met, at the beginning of Pershing, I met a guy named Oliver White, who I believe is one of the, he's become recognized as one of the top fly fishing guides in the world. Very smart, interesting guy, taught me fly fishing. And I said, look, if you're interested in business and you want to intern at, learn something about it, come work for me. And Oliver came and spent 18 months with us. You're taking a very outdoorsy guy and you're putting him in Manhattan, which is kind of an interesting thing. He didn't like that part of it. But he learned a ton about business, and then he left. He actually worked a lot on one of our proxy contest situations. In the Ceridian, we had a proxy contest. One of the issues was the CEO was using the corporate jet to do a lot of fly fishing junkets. So we were able to track that stuff through his network of fly fishermen. So it was useful in the proxy contest. Anyway, and Oliver left, I backed him to buy a fly fishing lodge, which is the Abaco Lodge in Abaco in the Bahamas. And it's like, a 20% unlevered return on capital, and he's done an unbelievable job managing it. And we hired a guy named Marius Adamski, who I met on the tennis court. Super talented guy, went to Wake Forest, top tennis player. And I offered him a job, and he's worked for us for the last couple of years. And he did a lot of the research on Herbalife. And he did a phenomenal job. So I just, he's going to go to business school because he needs more training to come back into the business. But I think it's a nice thing to offer people those kind of opportunities.
Well,
I was offered opportunities like that.
I'm glad I flew down with you. Maybe I have a role at Pershing soon.
That lasts forever. We want a business that sells a product or a service that people need and that is somewhat unique, and they have a loyalty to this particular brand or product, and that people are willing to pay a premium for that. I mean, another good example might be a candy business. While people are willing to buy generic versions of many kind of food products, flour or sugar, they don't need to have the branded product. When it comes to candy, people don't tend to like the Walmart version or the Kmart version. They want the Hershey chocolate bar or the Cadbury chocolate bar or the See's candy. They want the brand, and they're willing to pay a premium for that. And so that's, I think, a key thing. You want the product to be unique. You don't want it to be a commodity that everyone else can sell, because when you sell a commodity, anyone can sell it, and they can sell it at a better price, and it's very hard to make a profit doing that.
Ones where we are confident we're right and everyone else is wrong. Okay, and you have to, in order to be, I've been accused recently of being arrogant, among other things.
No, I'm going to actually ask you that. It was pompous, but that's okay.
Pompous? I don't think I'm pompous, but I've certainly been accused of being arrogant. And there's a difference between arrogance and confidence.
Yeah.
If you're arrogant in investing, you're going to get killed, right? If you're not confident, you'll never make an investment, right? So you have to do a sufficient amount of work to be confident enough to have the conviction to do something that's contrarian, right? We bought the stock of a soon-to-be bankrupt a shopping mall company during the financial crisis at pennies per share. You have to be willing to look silly when you do something like that. General Growth stock's up 90-fold since our original investment. We had confidence. Maybe people thought it was arrogant to believe that we could be successful in turning it around. But you also have to be humble. And you have to recognize when there are new facts you hadn't considered that are inconsistent with your thesis. Well, if you look at Herbalife, none of the bull case for Herbalife, none of those arguments have, in our view, any merit. And therefore, we continue to have conviction. But if we were to learn a new fact, that all of a sudden we realized Herbalife was a great company and it wasn't a pyramid scheme, and the products really had tremendous efficacy and they were priced correctly and there was real demand for them, we would change our mind.
If you're investing for the long term, you want to invest in businesses that have very little debt. In our little example before, we talked about our lemonade stand. There's $250 worth of debt. That didn't put too much pressure on the lemonade stand company, but if it had been $1,000, we hit a rough patch, the business could have gone out of business for failure to pay its debts. The shareholders could have been wiped out. So if you can find a company that can earn attractive profits, that doesn't have a lot of debt, where they generate vastly more profits than they need to pay the interest on their debt, that's a safe place to put your money over a long period of time.
So I'm pretty sure, I may be mistaken, that your entire portfolio is U.S. except for Canadian Pacific Railway, which may have been your best performer last quarter. Why is this your only non-U.S. play? And do you think actually this may be a trend where you're starting to look outside of the U.S.?
So we do very few things. In fact, we do very few things a year. Right? If our average holding period is 4 or 5 years for our kind of active investments, and we have 10 stocks, right, we need to find a couple of ideas a year. it doesn't make sense to me, unless the universe we play in, we've run out of targets. Why fly to Europe to have a meeting with management? Why deal with a jurisdiction where we're less well known, where we have fewer relationships, we don't understand the legal system, the regulatory environment. So we focus on the United States and Canada. We've invested in Canada before because we understand the language, we understand the law. It's close to home. It's a short flight to Calgary is an extra few hours, but it's just close to home. I can go see my kids.
So you like to feel and touch it?
Yeah, it's very important.
That have what people call barriers to entry. You want a business where it's hard for someone tomorrow to set up a new company to compete with you and put you out of business. I mean, like going back to the Coca-Cola example. Coca-Cola has such a strong market presence. People have come to expect when they go to a restaurant, they can ask for a Coke and get a Coke. It's very hard for someone else to break in. And of course, there's Pepsi and there are other soda brands, but Pepsi's been around a long time. Coca-Cola and Pepsi have continued to exist side by side over long periods of time. So when you're thinking about choosing a company, make sure that they sell a product or a service it's hard for someone else to make a better one that you'll switch to tomorrow. The way to really understand investing is to understand a business. And one of the most important skills you need as an investor is distinguishing between a great business, a good business, a fair business, and a bad business. And one way to get a sense of the quality of a business is go to work for one. So the recommendation I give to people graduating from business schools these days is this is the greatest time in history to work for a startup. There are lots of incredibly interesting businesses being formed. And if you can be one of the early employees, you're going to learn a lot about how a business works, how to make payroll, how to market your product, how to design something. And those skills, I think, are invaluable. First of all, you might even find it really interesting. You might have joined the next Facebook, so that's one thing. Even if the business fails, you'll learn a ton from that. I think that's the best experience you can get, ultimately, to be a good fundamental investor. You also want businesses that are not particularly sensitive to outside factors, so-called extrinsic factors that you can't control. So if a business will be affected dramatically if the price of a particular commodity goes up, or if interest rates move up and down, or if currency prices change, you want a company that's fairly immune to what's going on in the world. And I'll use my Coca-Cola example. I mean, if you think about Coca-Cola, it's a product that's been around probably 120 years. Over that period of time, there have been multiple world wars, development of nuclear weapons, all kinds of unfortunate events and tragedies and so on and so forth. But each year, the company pretty much makes a little bit more money than they made before, and they're going to be around. And you can be confident, based on the history, that this is a business that's going to be around almost regardless of whether interest rates are at 14%, whether the US dollar is not worth very much, or the price of gold's up or down. Those are the kind of companies you want to invest in the long term. Businesses that are extremely immune to the events that are going on in the world. I went to business school to learn how to be a good investor. And I learned the first rule of investing, which is you do your due diligence before you wire in your money. And when I got to HBS, I actually opened the course catalog for the first time, and there wasn't a class on investing. Now, there were classes on accounting, there were classes on finance. So I decided I had to develop my own little self-study program. And I wanted to, so I opened a Fidelity brokerage account. And I said I had some money I'd made in the real estate brokerage business. This was my tuition in the investment business. And it was about a year of tuition. And if I lost it, it was as if I had gone to business school for 2 years but paid for 3. So I figured it was like the inverse of the Oxford 1+1 program. But the first stock I bought went up. And then I said, okay, I found what I want to do. A little more involved. Another criteria, if you think back to our lemonade stand company, as we grew, we had to buy more and more lemonade stands. Now, those lemonade stands only cost $300 each. But imagine a business where every time you grew, you had to build a new factory to produce more and more product. And those factories were really expensive. Well, that company might generate a lot of cash from the business, but in order to grow, you're going to have to just reinvest more and more cash into the business. The best businesses are the ones where they don't require a lot of capital to be reinvested in the company. They generate lots of cash that you can use to pay dividends to your shareholders, or you can invest in new high return, attractive projects.
And then there's this guy that I met, money manager named Bob Chapman, who I met on a panel 7 years ago. We were on a panel together, shook hands. I've never spoken to him since. I've never had an email correspondence. I've never seen him since. But in the last 90 days, he's been running the talk show circuit on how I'm, either wrong or stupid or arrogant, giving quotes to Vanity Fair. It's unfortunate. I don't mind criticism, but I don't like reading things that are it's hard to read. For someone who doesn't know me well, to be commenting on what I'm like
Right.
as a person, I find that difficult. But whatever. You have to have a thick skin to be in this business. If you end up in a very public situation, you should expect to have fans and critics. And I just try to focus on what my job is, and we focus on making money for our investors. And I live my life. My approach in business, in my personal life, in a management role, is extreme candor. And I think that if you live that way, you'll run the risk of offending various people over time, but you'll have much better relationships because, if you tell people the truth, first of all, it's not typical. A lot of people, in the interest of politeness or fear of confrontation, or it's just uncomfortable, don't speak the truth. And that goes for people on boards. There are lots of examples of super talented people sitting around the room as an institution is failing. Think of all the banks during the crisis where people were not willing to confront the CEO. So I'm willing to confront the CEO, but I'm completely candid with him about his successes and his failures. I don't know, there are very few people, you look at the most successful people in the world, I know very few of them that haven't had a major failure. If you read through they're not the financially most successful people. If you read through the Forbes billionaire list and you read their stories, they've had failed businesses and they've lost everything and they've hung on they've almost died holding on to the ledge. What's his name? The guy on CBS and Sumner Redstone.
Redstone, yeah.
So there are lots of examples of people who had huge adversity. And I think it's how you deal with adversity that determines your ultimate success, as opposed to how you deal with success that determines your ultimate success.
So which of Bill Ackman's rules resonated the most with you? Comment your favorite below. If you enjoyed this video, go ahead, smash that like button, and definitely subscribe. See you next time.
Coming in, flex, I just wanna win, LABB who we running with, coming in, flex, I just wanna win,